After years of pumping money into the economy, the Fed has now pivoted 180 and is starting to remove this money from the system, a process that many investment firms have warned could cause catastrophic consequences for the stock market. Today I'll be taking a closer look at this process, as well as the knock-on effects it could have on the wider economy and asset prices in general, including why this could be a perfect storm for total economic collapse. So quantitative tightening is the main reason why the Fed could potentially crash the stock market in the near future. So certain large investment funds are concerned that one of the major concerns and risks in the stock market right now is quantitative tightening. So quantitative tightening, also known as QT, is something that the US economy has not experienced over recent years. Instead, the Fed has been carrying out the opposite over the last couple of years during the pandemic, which is quantitative easing. So quantitative easing involves central banks buying assets on the open market, mainly government bonds, but can also be other types of assets as well, essentially putting money into the economy in a positive way. Quantitative tightening is the opposite and involves central banks taking back that money supply by no longer buying assets in the open market, but instead selling assets. This ultimately adds cash to the central bank balance sheet, reducing the money supply in the overall economy. So the types of assets that are bought and sold during quantitative easing and tightening in the US by the Federal Reserve are mainly treasury bonds, however also include mortgage-backed securities and also corporate bonds as well. So by nature, when you are reducing the amount of money in the economy, you're also reducing liquidity in the market. So there is less money overall floating about, which means that there are also less buyers for assets. Many investors are concerned that right now is not a good time to be switching on QT, when you consider the fact that there are also various other negative things the economy and stock market are also dealing with right now. This includes rising interest rates, sky-high inflation, as well as already depressed stock and bond prices. So introducing QT now would be one more negative factor that we have to take into account that is thrown into the mix that could affect the stock market. Now, as of this month, which is September 2022, the Fed is doubling the pace of its bond sell-off, aiming to reduce its treasury holdings by $60 billion and its mortgage-backed securities by $35 billion every single month. So we know that by nature, QT is not a positive thing in general for assets, and the last time that the Fed carried out any meaningful QT was in 2018, in which we saw a drawdown of around 17% in the S&P 500. Now, this certainly suggests that QT has a meaningful impact on the stock market and is likely to do so again in 2022. So Ray Dalio's hedge fund giant, Bridgewater, are among those concerned about the impact that this increased pace of QT could have on the markets, warning of a potential liquidity hole as a result. Additionally, one of the main strategists at the Bank of America has said that QT alone could lead to a 7% price drop in stocks. So it's clear that a lot of large financial institutions and investment firms are very concerned about QT and the consequences that it could have across global markets. And it is clear that they believe that the Fed needs to approach with caution right now with all the other stuff that is going on in the economy that we're dealing with. The Fed's balance sheet, however, is rather bloated right now after around 2 years of accumulating assets at a fairly rapid pace. So their reserves hit as low as $1.5 trillion in September 2019, however it started to surge rapidly in March 2020 when the pandemic started. So assets then peaked in December 2021 at around $4.2 trillion and have since started to drop off to the point where we are at now, which is around $3.3 trillion. So we have already seen assets fall by around $900 billion since the peak. However, we are still much higher than pre-2020, and there is still, therefore, a lot more selling that needs to take place for the Fed to drain their reserves back to pre-2020 levels. So the 14% decline in the Fed's reserves between December and July correlates very closely with the roughly 15% decline that we have seen over that same time period in the S&P 500. So if the Fed were to continue QT to get back to pre-pandemic levels of around $1.55 trillion, that would be a roughly 47% decline from the current level of reserves. Now, I'm absolutely not saying that the S&P 500 will drop by a further 47% from where it is as of today. However, this correlation does suggest that QT of this extent is likely to have a significant negative knock-on effect on the S&P 500. So central bank reserves are created as a special form of dollars that can only be held by banks and other similar firms that are used to settle debts to each other, And since QE began in 2020, their reserves have got incredibly bloated due to the Fed creating reserves to buy bonds from banks. So large quantities of these reserves have now been returned to the central banks via money market funds. So for now, the loss of reserves is not a problem, as banks had plenty of deposits and reserves anyway, as well as $3.3 trillion in remaining reserves, which is still more than they've had in recent history. However, there are certainly risks on the horizon, including how the loss of reserves will impede banks' willingness to take risks with investing, which in a choppy market like we are currently experiencing, this could lead to widespread withdrawals from fund managers, forcing large-scale sales of stocks and bonds. So if banks are constrained and unwilling to deploy capital, they won't be able to cushion the price declines, and overall this could cause downwards pressure on markets. So how could QT lead to a potential perfect financial storm? So QT on its own is not necessarily a bad thing. However, in today's climate of 2022, it could well be the final ingredient for a perfect global financial storm. So let's take a closer look at the other pressing issues that global markets and economies are facing right now. So US inflation is still extremely high, at levels of around 8.5% as of July, despite falling from its peak of 9.1% in June. So other global countries are experiencing similar levels of inflation as well, some even higher than this. So this is not just a US exclusive problem. Now, because of sky-high inflation levels, the Fed is being forced to hike interest rates to stop things from getting totally out of control. Now, analysts do predict that rates won't start to fall again until next year, in a best-case scenario. And rising interest rates obviously increase the rate of return on safer assets, making risk assets like stocks less attractive to own. And then additionally, high interest rates also make borrowing money more expensive, and therefore negatively affecting companies that have been utilising cheap borrowing in recent time. Now, inflation also has a negative impact on the economy in general, meaning that earnings tend to be hit across the board, and so inflation also impacts companies that are profitable and don't necessarily actually borrow money. So if consumers are being hit by rising prices and rising costs of living, they are not going to be able to splash the cash as much as they could do before, and this is likely to continue to hit earnings for many companies in the coming year. So if earnings do start to decline and companies are predicting lower growth in earnings, then this is also going to have a negative impact on how the market values these stocks now that they are generating less profit and expecting lower growth in the future. And of course, we also have the impending energy crisis that will be hitting the West this winter, as energy bills are expected to rocket, and we could well even see blackouts as well this winter. We recently officially entered into a recession, despite some people arguing that we are not actually there yet, but there is real fear that this situation could escalate into a more severe recession, where many aspects of the economy are hit hard and unemployment surges because of the weak corporate performance, leading to layoffs and reduced hirings. So all in all, with the economy and stock market looking quite weak right now, and potentially set to become even weaker over the next 6 to 12 months, ramping up QT could be a big mistake from the Fed and lead to carnage across the economy. It seems like many large financial institutions are worried about the consequences that this could cause and are advising the Fed to proceed with caution when it comes to QT. However, looking on the positive side, there is hope that the Fed will be monitoring the situation quite closely and will be able to act quickly if it looks like they are speeding up with QT too quickly. So the balance sheet will also be draining at a slower rate than how fast it grew during the pandemic. So at least we know that there is more time for the process of QT to take place compared to what happened with the QE over the last couple of years or so. And therefore there are more adjustments that can be made by the Fed along this way. So it's also believed that there is a lot more liquidity in the system to support markets today than there was back in 2018 when we last saw any meaningful QT take place. So this will also hopefully act as somewhat of a defense against any sharp market crashes. So that is all for today's video. I hope you did find this video interesting and informative about the process that is taking place with quantitative tightening by the Fed. And the potential negative consequences that this could have on the economy and the stock market, and the fear that certain large financial institutions do have around the process that is going to take place. Obviously, this does have potential to have a severe negative impact on the stock market and the economy, but you'd like to think that the Fed will be monitoring this very closely, as I mentioned at the end of the video, and if anything does get too out of hand, then they will be quick to act and start to soften quantitative tightening and slow down the pace that it's taking place in. With that being said though guys, this video is purely based on my own thoughts and opinions, based on my own research. It is not financial advice and I'm not a financial advisor. It's for purely entertainment purposes only. But apart from that, thanks a lot for watching. Please leave a like if you did enjoy the video, as that does help out a lot. Also be sure to drop me a comment, let me know what your thoughts are on quantitative tightening and what it could do to the economy and the stock market. I'd be really interested to read those. Be sure to subscribe as well if you want to see more videos similar to this in the future. But apart from that guys, thanks a lot for watching.